Hello everyone, my name is Robert Woodward. I'm a client relationship consultant here at Capsim, and we are going to be talking about finance today. Okay, so on that note, I'm starting from my login screen, and I'm going to log in and we're going to talk about finance. So here is what I'm looking at, all right? So up top we have any investments that are carrying over from production. So I see $92,600,000 for total investment. Right? That is plant and equipment that I am purchasing. If I am selling anything, then I'm going to see that here in red. So in other words, if this was 92 million and this was 25 million, then I would subtract the 25 from the 92 because I don't need to finance that amount, okay, because that is coming from the selling of assets I already have. Okay, now this is the section where we are dealing with financing through equity, okay, or the retirement of some equity that we have. So, for example, this is the number of shares we have. Of course, that's 1,000, so we have 3.3 million shares. We have stock price. We got our current earnings per share based upon our forecast. Okay, and just as a reminder, everything you see here, cash position, earnings per share, those are pro formas based 100% on your forecast. So of course, make sure that the forecasting is that it's in there in place, and there's not it's not being based upon a benchmark prediction, which we've covered in the past, where it's not a good indicator. Okay, now you're also given what you can raise through selling of stock. Now, just as one thing to keep in mind is that you have these information bubbles. Okay, you can only sell a certain amount, and there are some brokerage fees on selling of the stock. Okay, so you can research and find out what those brokerage fees are when you decide to sell that. So if I were to say I'm going to raise 20 million in stock, you're not going to get a full 20 million here. You're going to get a portion of it. You're going to get the majority, but you are losing a bit. Okay. Or if you're in the situation where you don't need to do a lot of financing, perhaps your company is running well. You have all the products you want. You have sufficient automations for those, and you have excess cash. This is a great time to manage your idle assets, okay, and to buy some stock back. You can even offer dividends. Okay, both of them are going to have an impact on your stock price. So the higher the stock price, the better. And it helps prevent you from having too much assets that's just sitting there. Okay, because that looks pretty poor to your future, to those who are looking into investing into your company. Okay, so this is where you are essentially running to the bank, talking to your personal banker and saying, I need a loan. I just need something that's going to satisfy me for the year. Okay, you are required to pay it back the following year. So, for example, I have $40 million, a little over $40 million that I borrowed in last year, or perhaps it's a bond from that was purchased before the simulation began that came due. Okay, that's all going to be lumped in there if one is required to pay one back. Okay, now with here, you're not given exactly the amount you could borrow, okay, per se, like max stock or max issue for the long term. However, you just type in an insanely large number, and it's going to correct it, saying, "Hey, this is your number," which is helpful in case you do need to borrow that. Okay. Now over here we got our long-term debt. Okay, this is long-term debt that we are bonds that we have sold that we're going to sell off, that we want to sell off early. Okay, we want to avoid maybe an interest payment. Maybe we're trying to reduce our leverage. Okay, both are good situations for that. Okay, long-term debt. This is where you are selling a long-term bond. Okay, so essentially a 10-year loan, where there is going to be an interest payment, and you're required to pay the lump sum back at the end of the term. Okay. Now, difference between the methods of funding is stocks and bonds are both long-term funding. which should be used to finance long-term projects, meaning plant and equipment automation. Okay, if you finance those plant improvements and you need extra cash, or you want to finance or borrow a little bit to cover some of your receivables or your inventories, that's a perfect time to just take care of something in the short term. Okay, so with that being said, the next area, we're looking at the receivables and the payables. Now, you start off at a base of 30 and 30. As of right now, I've changed them. Doesn't necessarily mean it's the most wise decision, but if you offer better credit terms, meaning higher than 30, there is a little bit of benefit. Okay, meaning it's going to drive a little bit of demand. Think of it possibly as a Walmart or Kmart's layaway program. There's going to be some people who buy on credit. Okay, some people who wouldn't have purchased something from you unless you offered them a little bit extra time to pay them back. So it helps drive a little bit of demand. Okay, now for payables, this deals mainly with your production. Okay, if you reduce the days, pay your suppliers faster, then there's less chance of any parts deliveries being late. And with that being said, instead of having your laborers waiting a little bit to do the work, now they have the opportunity to not wait, meaning they're going to get the full output out. So as you play around with this will affect your forecast. This will affect the benchmark predictions in a sense, in a little bit. Okay, this will affect your production after adjustment number on your production. So go and play with those numbers. Look in your online guide, because it's going to give you instructions of how those affect you, of course, how it relates to the simulation. Now, of course, you pay people faster, and you give people more time to pay you back. That's eating into your cash flows. That's cash that's not there yet. So there are downsides to changing those. Okay, now, with the current situation that I'm in, I am investing $92.6 million. Okay, about all I could possibly raise. I'm being aggressive and trying to grow my company. Now, with that in mind, my job is to try to finance that $92 million. Okay, so if I were to fund the full amount through stock, okay, and I'm going to fund the majority of it through debt. Okay, so I'm covering 80, 92, right about 92 million. Okay, so back to where we were. I am spending the 37 million in stock, and I am essentially spending the whole amount in bonds. Okay, so I am fully financing my plant improvements, which is good. However, I'm still having a cash flow issue. Okay, so this is a situation where if my financing is fully covering my investments, then there appears to be an issue on operations. So maybe I am just not as profitable as what I was last year. Maybe it's because I got a current debt that's coming due. Okay, maybe I just got too much inventory. Okay, so there's numerous reasons, but in this situation, assuming your forecast was how you want it, okay, you're confident in what they do, this is a situation where you take out a current debt. Okay, now you could cover 100% of it. Okay, now of course there are fees, so you're going to lose a little bit. Okay, now in addition, you want to give yourself a little bit of a cash cushion. It's going to alleviate a lot of your risk of receiving an emergency loan. If you cover about 5% or so of your sales as cash, it's going to alleviate some of your risk. So for example, 200 million, 206.7 million, 5% of that would be higher over 10 million. So that would be an appropriate cash cushion based upon your expected forecast. So in that case, yeah, I would probably borrow when I have at least the 10 million or 10 million in cash, assuming the actual, and probably less with assuming the worst case scenario. Of course, you still want to alleviate as much risk as you possibly can. Okay, so as you're playing with these numbers, make sure that you're in a situation where you're content, where you have done everything you can to avoid of course, assuming the forecast is within the ballpark. Now, say perhaps instead of doing so much in investing, I'm pretty good with my plants and I don't need to do as much in investment. Okay, you're going to get in a situation where instead of 90, you got 20, so maybe 10 million here and maybe 10 million here. Oh, and that's 1,000, so 10. Give me one moment. Okay, I'm going to change a couple forecasts, so give me one moment. Because I know I'm going to sell more than this. Something like that will work. When I go back to my finance page, now I'm in a situation where I have excess cash. Now, in other words, if I have this much cash, perhaps that's too much. Of course, assuming, again, I'm in a worst case scenario. Now, if I were to go to some of my ratios, I see here that I have 94 days of working capital. That's a little too much. It's more than what we need. You know, it kind of makes sense with us sitting on $20+ million of cash. So with that in mind, this is a good opportunity to give back to some of your investors, or to just perhaps buy back some of the stock that you've sold, or maybe just don't do all the funding. Okay, because there are situations where you don't need to fund 100% of it. Okay, so if that being said, I still have $15 million in cash. Perhaps I want to buy back a little stock. Now, one thing to keep in mind here is that when you do that, it's going to have a positive effect on your earnings per share, which is going to correlate to an increase in your stock price. Okay, because it's not affecting your profits, perhaps, per se, but because you have less shares outstanding, the earnings are higher per share. Okay, let's see here.